Hello, my name is Grant Clayton, and I'm an assistant professor of finance here at the University of Kentucky. And I'm also an affiliate of the Institute for the Study of Free Enterprise. The stock market is all about investors and their expectations of the future. And so it's an interesting question to ask. When did this start to happen? And specifically, did it follow, was it reacting to the coronavirus news? Was it around the same time? Was it beforehand? And the investors' reaction to coronavirus in the stock market actually began in February, preceding the big surge in cases that we saw in late March and that we're still in the middle of. And one of the interesting sources I like to look at, and I've given you the website up there, is out. Now, this isn't allowed in the US, but outside the US, bettors gamble on the likelihood of a recession occurring in the US in any given year. I know that sounds sort of strange, but there are actually bettors in the United Kingdom or prediction markets that operate in New Zealand, and a very interesting website called electionbettingodds.com actually sort of put these together for the public. And you can see things, as the name implies, on like who's going to be elected president and things like that. But one of the things that bettors bet on is, will there be a recession in 2020? And this is actually combined from two sources: Betfair in the United Kingdom, which takes bets, and Predictit, which is a prediction market out of New Zealand. And as you can see there, heading in, say, about January 2020, look at the red line, which is the probability of a recession that we're taking. It's like if you were looking at sports bettors and they were betting on money on who's going to win, you could sort of calculate what do they think the probability of that team winning. This is the bettors essentially betting on what's the probability of a recession. And there's always a probability in any given year, but it was hovering below 20%. And then in late February, before the major increase in cases, suddenly you see in the space of about a month, from about late February to late March, the probability of a recession in the US in 2020 that bettors were betting on rose from around 22% to 91%, an almost certainty. And so you can see there, just in that one chart, that when did the expectations change? When did investors start changing their minds? And the answer to that, because we can back this out of the data, is in late February. And if you look over there on the bottom right, notice how that corresponds so clearly to the stock market. As the expectations started changing, notice there in late February, that decline in the S&P 500, by the end of March, investors had already factored in we were headed for a recession. And what this is, and this is something that in the midst of this event, this is a classic example of the stock market acting as a leading indicator. So economists often consider the stock market a leading indicator, meaning it's not just an indicator, it's not primarily an indicator of what's happening now, it's more an indicator of what investors expect to happen in the future. And that's what we mean by it being a leading indicator. And what's interesting to look at is the stock market's large loss actually mostly preceded the severe increase in coronavirus. And this is exactly how financial markets work. So if you look at this, and this is from a very useful website that I look at called worldometers.info, and they sort of gather information from different health sites and state websites to explain what the cases are doing. The global cases really started to turn up. You can see it happening. And then the massive increase in cases that has had such tragic consequences starting around March 18, 19, and if I remember correctly, this is around when California began to issue the stay-at-home orders, and here in Kentucky, a little while after that, we would have our order. And so by around late March was when the severe increase, mid to late March is when the severe increase of these cases occurred. Okay, so the market's collapse beginning in late February reflected an anticipation of the surge in cases that we actually witnessed in late March. So the big question here is, how does this crisis compare so far? And I really want to highlight the so far, because it's always dangerous. It's premature at best to be summing up this in terms of its economic effects when we're actually in the very middle of this crisis. And the first bullet I want to highlight, even though this conversation is about the stock market, is of course this crisis, when I compare to some of these other crises below, this crisis is unique and very terribly unique in its human toll, and also the extent of complete shutdown that has been required to limit the spread of the virus. And so I don't think anything in that table even begins to approach the level of the loss of human beings and the deaths and the sickness and horrible suffering. Nonetheless, I do want to compare it to other significant losses in the market. And as you look at it there in the table, currently, the worst it got recently was the market had lost 35% from its peak. If you look and compare to, say, the three most recent market crises, actually that's on the smaller side. With the financial crisis, the dot-com collapse, we saw losses in excess of 50%. With the 1987 market crash, so far that's probably the most similar, we saw a loss of 36%. Another thing I wanted to highlight in this table, we have only been seeing these market disruptions for the past, say, month and a half. The good news and bad news about this is something like the 1987 market crash lasted around 2 to 3 months before the recovery came. But if you look at the dot-com collapse, when all the internet companies lost value in the early 2000s, or the financial crisis, these declines can take a gradual period of time of up to 2 years. We could be in the very early days of these losses, or it could be more like a 1987. The 1987 crash, as you see there, happened pretty much on a single day. We saw a massive loss in the stock market, basically a rapid 36% loss, and then a pretty quick turn to recovery. Now notice, the recovery was fairly slow happening. Now, in contrast, here you have the 2008 financial crisis. And if you look at this one, there is, if you can see my mouse here, a loss right around there in October when Lehman Brothers and all the different financial events were occurring. You saw a pretty fast loss. But then as you look at that, it took months for it to ultimately bottom out. And so it was a mostly fast decline. This all took place, if you look at this chart, within about a year. Then probably the one that I think we're all hoping this is not going to resemble is the dot-com collapse. And so if you look at the dot-com collapse, and this is where I would add a bit of caveat around looking at the most recent rebound as being the end of the story. In the 2000 to 2002 range, now remember we had the collapse of the dot-coms, we also had the 9/11 terrorism attacks. A lot of horrible things were happening. But if you look at this, it was a gradual, slow, grinding 2.5-year loss with little momentary rebounds, but a continuing loss. Ironically, in late March, that's when the S&P 500 has actually been recovering, and now it's well over 10% of its value. And this can often be confusing to people as they observe the market, because on the one hand, you're looking at the news stories, which are saying today, like I remember a few weeks ago, it was like today is the biggest day of new cases that we've seen. And, you know, Governor Cuomo in New York, we were in the absolute middle of the worst of it, at least what we hope is the worst of it. And yet the market's increasing in value. And this can often be very frustrating and very hard to understand of like, what are investors thinking? Why would the market be going up in valuation? Meaning investors are paying more for stocks and believing things are going to be higher. Why are they doing this in the middle of this horrible news? Well, remember, it's like the late February story. The market anticipates events. So just like the market's collapse was occurring well before the surge in cases, well, it would seem right now that even though we're at the middle of the severity of this outbreak, the S&P 500 and the stock market increasing in value could be investors anticipating the beginning of a recovery. You know, I'm just totally guessing here, in late April or May. However, and I want to stress this so emphatically, setbacks and bad events, of course, could lead to a renewed loss in markets. In other words, you do not want to treat the market as some kind of a crystal ball or a source of secret wisdom. The way to think about the market in this case, it's amalgamating, millions of investors' expectations about what's going to occur. And so this recent price movement suggests at present that investors are expecting the beginning of a recovery. We all hope, not just as investors, but as human beings, we all hope that expectation turns out to be true.